I would look at the return, that's venture capital. So generally, when you're investing in something like that, you have to be expecting you're going to lose all your money. So that's number one. You just need to be able to do that. So, you need to approach it from the mindset of this isn't going to pay off. So whenever you invest in a business, you got to expect it to fail. So then you look at risk reward. So what's my upside, given the fact that I could just lose all my money and the business could fail, going into a recession where housing is correcting, most of the builders across the country are pulling back and stopping construction and not buying. Have these people ever been in this business before? Building materials, that kind of thing. That's a very difficult business, commodity driven. So you got to look at all those factors in terms of the people running the business, the operation, that kind of thing. And then, like I said, then you can say, okay, given all that, there's very high risk to something like this. I'm not getting paid for 5 years. So what do you want in exchange for an investment like that? And it needs to be a very significant premium on something like that. I mean, it's risky, so it's up to you, whether you're willing to wait, whether you think it's going to work. And, they are coming into it at one of the worst, potentially worst times to be coming into it. Cause like I said, builders are pulling back all across the country right now. Yeah, it could shift because if builders pull back right now, we go through a recession, we should be out of it in a couple of years and then, right back. So that's how the cycles work and, demand. But again, the decision would be, are you willing to walk away from it if you lose the money and, and be okay with that? Whenever you invest in a business, you always have to invest from that mindset. I'm going to lose this money. Am I okay with that? So, at the back end, when you get through it, the market changes and the land is worth half of what what it was originally worth. You have to renegotiate. You have to go back to the seller and say, look, I can't, the value's not there anymore. The market's changed. You need to show them why. The only way I can do this deal is if you reduce your price. So it is what it is. And if that's the market, they're not gonna be able to sell to anybody else. And, your only downside there is the money that you've spent, along the way. And you could always extend and just say, well, let's wait, if he doesn't want to do that or seller doesn't want to do that, you say, well, let's just extend it until the market comes around and we can move this property. Because if the market is contracted that much and you can't move it to make a profit or you can't move it at all, you can't buy the property. So you just have to renegotiate or wait. Yeah. I mean, you obviously are going to have an assumption, so you wouldn't go into it if you didn't think, it was going to be worth more. So you want to make sure you've got a big margin, number one, 30 to 50% minimum. Usually land is many multiples above that. But, if you've got a 30 to 50% margin, generally it takes a little time for markets to contract that much. 2008 and 9, it happened pretty quick, at the end there. But, right now, what we're dealing with, you can kind of hedge some of that and anticipate, well, the market might be off 20, 30% a year from now, 2 years from now. So, you got to make some assumptions and base your initial purchase price on those back end assumptions. And then if the assumptions are wrong, hopefully they're wrong to the upside where you can get more than you thought, and you want to be conservative about that. But again, if you're wrong, the market changes significantly. You just can't anticipate that. You can anticipate a little bit right now in terms of, maybe it's going to be off by 20 or 30%, depending on the market. You need to really understand that market, what the values are doing. And, just be ready for that at the back end when that comes along. If it's a really good piece, then maybe you take it down, you hold it for a while and wait for the market to come around. Or like I said, you just extend with the seller or you just renegotiate the price. But yeah, you got to make some sort of assumption where you think it's going to be. Otherwise, you've got nothing to start with. Oh yeah. If I can't make 30 to 50% on a development, on the land, I'm not going to do it. That just because there's so many things that are going to go wrong. Now, if I'm just flipping and I'm not doing anything, then you can have thinner margins, like, just 30 days or whatever. But if I'm going to take a piece of land and go through a year or two of entitling it to get it ready and all that, yeah, I need to be able to make at least 30 to 50%, on that, cost in order for it to make sense. Otherwise, it just doesn't make any sense. I'd typically like to at least double my money, but minimum 30 to 50% in a hot market.
All right. Thank you.